Hello everyone and welcome to AUT Financial Modeling, your go-to destination for financial models. Today I'm going to discuss a solar power plant template that can be used for anyone who is trying to set up or look at the opportunity of setting up a photovoltaic power plant. A well-constructed financial model can be used for making decisions as it is crucial for ensuring the project's economic viability, attracting investors, and making informed decisions throughout the life cycle of the power plant. In this financial model, there are various sheets and various options for the user of financial model to look at. There is an assumptions sheet which contains various types of assumptions that are required. Then we have the energy production schedule, the inflation pricing data, our operation and maintenance cost. Then we have output sheets. In output sheets, there are income statement, balance sheet, cash flow statement, fixed asset schedule, a debt schedule, and then we have the analysis sheet, which contains key financial ratios, free cash flow analysis, and then a summary of the model. We have some key charts to look at from the perspective of an investor or someone who's trying to set up a power plant. But first of all, let's start with the introduction. So in the instruction sheet, you can find the instructions for the whole financial model. So first up, we will try to understand the structure of the model. In this model, whatever is input in the blue shade is assumptions. In the black shades, there are outputs or calculations. There are general settings such as currency, units, project life of this project, the capacity of the power plant, and all. Then you have assumption sheet, like I said, and then there are instructions for how to use this model. Then next we have the capex sheets. Then we have phasing plans. We assume that all the construction will not happen in the one phase, so we have phasing plans also. Then we have revenue assumptions about the solar yield, the capacity degradation of the plant, the sales split that is going to happen. Then we have the duration of whatever the sales splits we decide. Then we have operating and maintenance cost. These are the description of those costs. Then we have income tax rate. Then in the fixed asset schedule, we have the depreciation, the fixed asset schedule, net working capital, and then in funding, we have the use of funds, that is, how we are utilizing our funds to buy machinery and whatnot. Then we have the sources of funds. Are we totally raising the money from a debt perspective, or just we are also issuing some equity? Then we have our output sheets, financial statements, income balance sheet, financial statements of cash flow. Then we have project metrics like unlevered free cash flow, then levered free cash flow, and lifetime projection of cash flows and profit. Then we have our investment profit, proceeds and multiple, internal rate of return, levered and unlevered. Then we have payback period and back calculation and net present value of the project. So now let's start with the summary sheet. Let's first look at the summary sheet, then we'll go back to starting from the assumptions. Now let's look at the summary sheet. In summary sheets, we have the following matrix, and we have our full project lifetime, calculations of revenues, our operating cost, then we have EBITDA, our depreciation of assets, then we have EBIT calculations, earning before interest and taxes, then we have interest reduction on our loan that we have taken, and after tax deduction we get the net income. So overall this is an aggregate of all the net income that will be generated over the period of the lifeline of this project. Then we have free cash flow calculation. We have ratios like EBITDA margin, return on invested capital, return on equity. Then this is our debt service coverage ratio. Then we have debt by EBITDA. Next, we have our matrices such as levered and unlevered internal rate of return. Then we have a payback period of free cash flows, as this shows us that in how many years the money that we have invested will get paid back. Then we have net profit, net present value of the project as well. Finally, we have some ratios such as debt service coverage ratio, the minimum maximum value of it over the lifetime of the project. And we have debt to EBITDA and EBIT to interest rate. Here we have a project lifetime profit. We have a waterfall chart. These are the revenues that are generated. The red ones are the cost, and green ones are just nominal matrices. So we have interest before interest, tax, and depreciation, amortization. Then we have EBIT, EBT, and then we have net income. Here, this pie chart shows the source of financing. So how we are planning to gather our finances. First one is the equity that you are trying to raise. Then we have a loan amount. We have three loans in this case, loan A, B, C. You can customize it according to your own needs. Then we have operating cash flow to fund our project. And here is the use of funds. So we have the most of our fund is getting used in the photovoltaic equipment. Then we have installation cost, VAT, inverters, and contingency fund, etc., etc. Now we'll look at the assumption sheet. In the assumption sheet, we have some basic assumptions about the model and some of the crucial assumptions that are required for the functioning of this model. So in the basic assumptions part, we have something like name of the power plant, the project. Then we have the currency that we are going to choose for our model. Then we have the start year for our project, then the end year, and we have the unit of the electric installed capacity and the electric output unit and the area in which our power plant will be made. And we have tax rate assumptions and the discount rate that we'll use when we try to value our power plant based on the cash flows that it will generate in the future. So electric installed capacity is something that tells us that at maximum capacity, what will the panel generate, or like what will be the amount of energy that panel will be able to generate. So it is in the unit of kilowatt power. Then the electric output is something that how much of energy that the plant generates. So for example, 3 kilowatt power of electric capacity means that the plant will be able to generate 3 kilowatt hour of energy per 1 hour at the maximum capacity. And next we have the energy sales assumptions. Like we have assumed that there will be two methods to sell our energy. First one be the power purchase agreement that we'll be able to do with any of the purchasers of power. It can be government or private. Then we have the market price rate. So it will be a mix of power purchase agreement and market price. Then we have the pricing that we'll do. So here is the pricing according to the power purchase agreement and the market price. And we have the split of power purchase agreement and the market price purchasing. So for 20 years, we'll assume that the power purchase agreement will go on, and after that, we'll do it by the market price. Next, we have the assumptions about the inflation. So, what will be the inflation in the power purchase agreement? What will be the inflation in market price rates, and what will be the cost inflation? Next, we have the phasing plan. It is like in what phase, how much of the plant will get constructed. So, we are assuming that there will be three phases mainly, and 50% of the plant will get constructed in the first phase, and 25 and 25% in the second and third phases, respectively. We are assuming that in which year construction of a particular phase will start, then in second is for the phase 2 and phase 3. And here we have the installed capacity in the phase 1, 2, and 3. And then next is the total installed capacity up till now, so it's cumulative for the years. Here we have the debt drawdown by phase. So how much debt we are going to take phase wise, that is being mentioned here. So this is the cumulative capex. This value has been calculated. So the blue ones you're seeing are the assumptions, and the dark or black ones are the calculated uses. Here we have the operation related assumptions. So in this we have something like project lifetime, the installed capacity, which is 5,000 kilowatt hour. Then we have the photovoltaic area per kilowatt power. So it's just the area divided by the kilowatt power. Then we have the PV module area, how much area will be required. Then we have specific solar yield. So specific solar yield is something that tells us how much energy that is kilowatt hour is produced for every kilowatt power of the module capacity. Next we have the annual solar energy produced per year. Then we have same matrix by square meter. This is the efficiency factor, and the annual capacity deterioration is how much capacity of plant will deteriorate over the years. Then you have some assumptions for the net working capital, that is days sales and days OPEX. That will help us in determining days receivable and days payable. Next, we have assumptions related to the capital expenditure. So these are the items that we normally assume in a solar power plant to be in the place of capital expenditure. So like photovoltaic equipment, installation cost, VAT, inverter, energy storage device, system balancing, component contingency funds, and others, etc. So you can completely add to this list and customize it according to your own needs. So here is the depreciation period for the equipment. Then you have operating and maintenance cost. So variable cost such as insurance, some other variable cost, maintenance charges, renovation cost, professional services cost, security expenses, and all. So these are operating and maintenance costs over the phases. We have cost matrix, so just the cost distributed per month, per kilowatt power, and the percentage of total capex. Then we have our debt schedule, so how much debt we are going to take. So in this, we have assumed that there are going to be a total of 3 loans, and these are the amount of loans, these are the interest rates of the loan. So like interest rate of loan A, B, and C. Then we have the loan repayment start year. So we are assuming that by the third year we'll start repaying these loans. Then we have loan terms, how long is the years, and how many years we are going to repay the loan, and all of that. So that was all for the assumption sheet. Now we'll go to the energy production schedule. So in the sheet we can see phase wise what is the energy production schedule. So this is the project lifetime. This is the duration of power purchase agreement. This is the 20 years. Then for the last 5 years, we are going to sell electricity at market price. So 25 years is the total lifetime of the project. 20 years is going to be the power purchase agreement. 5 years is going to be the duration for market price agreements. Then in this phase, we have this is a construction phase. So for U represents under construction phase, and G represents our power plant is generating energy. So by phase, we have divided our construction phases. So here we have the capacity. So how much of the capacity we'll have over the years in phase 1, phase 2, and phase 3. So as you can see in year 2023, that is year 0, no no phase is generating any sort of capacity because the construction will take 1 year, and by 24 50% of our capacity will be ready. The next year second capacity will get ready, and then third year the third capacity will get ready. Hence here is the adjusted capacity. So this is the deterioration that we have taken from the assumptions. Next we have the adjusted capacity by phases. So 100%, 99.5% because of the deterioration. And this is the adjusted capacity, is just the average of capacity by phases. Here is adjusted capacity. It is simply the multiplication of this capacity by the percentage. Then we have the specific yield radiation, which we discussed earlier, is the how much kilowatt of energy is being produced for every kilowatt power of the material capacity. Then we have our electricity produced, and this is a metric kilowatt hour per megawatt power. Next we have the sales allocation, how much is allocated to power purchase agreement and how much is allocated to the price. So we have assumed until year 20, that is 2043, 100% power purchase agreement, and then next year we are selling it at market price. And this is the combination of power purchase agreement and market price news. Hence we get our kilowatt hour of energy produced. This was our energy production schedule. Then we have inflation and pricing data. In this, over the years, we see how much inflation is happening in power purchase agreement and market price, energy prices, and all the cost that we are going to bear for the running of our plant. We can see that if you assume there will be zero inflation in the power purchase agreement and energy market price, you can adjust it according to your own usage. We have assumed there will be 2% inflation in the cost that we are going to bear for our plant. Here is the power pricing for our power purchase agreement and energy market price. In the next, we have operation and maintenance cost. So we have assumed that at 100% operation levels, this will be the variable cost. This is nothing but our variable cost. It's a percentage of the revenue. So we are doing it by multiplying with revenue. Then we have other variable cost, then maintenance charges, innovation cost, and others. So in the operation and maintenance, we get these will be a cost. Then we'll see at what capacity we are running our plant, So, yeah, so these at operation levels, these are just the multiplication of 100% capacity to the capacity that we are setting at for operation levels. Then we have operational maintenance matrix, that is dividing these values by just the kilowatt hour of production. Next, we have our income statement in which we get the revenue generated by power purchase agreement. As you can see, it is energy production schedule F51 inflation pricing data. That is the amount of energy generated by the power purchase agreement multiplied by the pricing that we are having in the inflation and pricing there here. Then we have the revenue generated, we have the cost from operation and maintenance cost. Then we have our depreciation that will come from the fixed asset schedule that we'll discuss in a moment. Next, we have the interest that we'll calculate from our debt schedule. And then we have EBT. And at the later stage, we get the net income for our power plant. Now let's look at the balance sheet. But before that, we must look at the fixed asset schedule and debt schedule. So in fixed asset schedule, we'll look at how our fixed assets are being utilized, how the depreciation is happening, and what will be their net value. So we'll assuming that by phases that we are constructing our model. In the first phase, we'll construct the 50%, then 25% and 25%. So this will be our capital expenditure that we have calculated by multiplying the total expenditure into the percentage of construction that is being done in that phase. Next, we have our gross total capex. There is a sum in that year. We can also assume if there is some maintenance capex that we are planning to have or for our power plant. Next, we have total capex. That is just the sum of these. And we have fixed assets at the cost level. So here is this, and this is just the sum of previous year plus the year that has happened this year, and so on and so forth. Next, we have the depreciation. So we're assuming that 25 years is the depreciation period, and taking straight line method, we have depreciated our capex. And as you can see, it is being depreciated over the course of 25 years. And if we go to the bottom, we can see the depreciation that has happened. This is the accumulated depreciation. That is the depreciation in the current year. As you can see, 54 was the previous year accumulated depreciation, and this is the depreciation in the current year. We have fixed asset net, that is the gross assets minus the depreciation. And that's how we have our fixed net assets. And creating this depreciation. So this depreciation value that is in the row 53 goes into the income that is being showed here, right here. So after the fixed asset schedule, we have our debt schedule. Debt schedule we assume and how we are drawing our debt. So after the total debt that we are planning, and what phases we are going to draw the debt, and how we'll repay it, what will be the interest rate. So this is the debt drawdown schedule. So there are three loans, loan A, B, C. There's the same calculations have been done for all three loans. We are taking one assumption that the drawdown and repayment is assumed to be happening in the middle of the year. We'll see that in a moment. So the principal amount of loan A is this. This is the repayment years, the interest is for the loan, and the debt drawdown. Like in the first year, we'll draw down 50% of the debt and 25%, 25%, and then we'll start repaying in the third year of the starting of the plant. So next, here we have the debt balance at the beginning. Then next, we have the drawdown that has happened in the year, the repayment, and the debt balance at the end. Then this is how we calculate the interest rate. See, we have calculated the interest payment for the drawdown and repayment in the middle of the year. So this is how we calculate the interest for a loan A. In a similar fashion, we calculate the interest for loan B and loan C. So next we have the total drawdown of the debt that has happened in the year, then the repayment that has happened. Then this is a change in financial debt. They have the financial debt for the year, and we have the interest that is being paid is just the sum of interest on loan ABC. Then you have the interest payments and the repayments. This is the debt service. So this interest goes into our income statement, as you can see right here. This is the interest that we pay on a yearly basis. After this, let's go look at the balance sheet. In the balance sheet, we have our property, plant, equipment, our fixed assets. This comes from the fixed asset schedule. Then we have our cash that will come from the cash flow statement. This is the account receivables that we have. We made an assumption about the days receivable and other current assets if you want to have. This is the total assets. These are deferred tax liabilities if you're trying to assume something. And this is the long-term debt that we are drawing. And this is the accounts payable. We assume the days payable. And we have other current liabilities, and this is the amount of equity that is we have to fund for the starting years. Also, if we look at this in the equity change in equity sheet, here we have the total liabilities, so this should match. So here is a sanity check for our total liabilities equation. And we have a cash flow statement. In the cash flow, we are following a cash flow statement. We are following the method of three parts in the cash flow statement. One is the change in cash flow due to working on operating activities. Next is the change in cash flow from investing, and third is the change in cash flow from financing. So here we have our interest before tax. Then we add back the interest. Then we add back depreciation. Then we take change in account receivable, other assets, change in account payable, change in current liabilities. If we deduct the taxes paid, then we get our net cash flow from operating activities. From investing activities, take is there any investment in the non-current assets or capital expenditure for the year. We have net cash in investing activities. We have a net cash from financing, that is change in the long-term debt, and in other non-current liabilities, the interest paid, dividends done, the financing. Next, we have net cash flow from the financing. We have net cash flow, that is the sum of all three. So equity financing is the financing that needs to be done so that our operation can keep on running, because the debt loan will not be able to service it. So this is the equity that we need to raise year on year until our operations become sufficient to fund our growth. Then we have our net cash flow. That is a sum of all three. Then we have our opening cash balance and the closing cash balance for the year. This closing cash balance goes into the balance sheet, as you can see here. Yes, right here. That we are done with all three crucial statements. And we look at some of the key financial ratios, such as economic ratios, net working capital, and fixed assets. And we have our capital employed. We have financial debt, how much is cash, how much is equity, how much is invested capital. Then we have bank ratios that are crucial to take any loan or anything from the bank, such as financial debt to EBITDA, loan A to EBITDA, B to EBITDA, C, our debt service coverage ratio, EBIT by interest ratio, the net debt by equity ratio, equity as a percentage of invested capital. So next we have the liquidity ratios, such as cash ratio, the current ratio, so how much liquid we are. This is what shows us. And we have a days receivable, days payable, and an asset turnover ratio. When we talk about the profitability of the company, we have net operating profit, and we have the percentage in EBIT, EBITDA, other income, return on invested capital, return on assets, return on equity, and so on. We have a free cash flow analysis, in which we do analysis based on the free cash flow from the firm and the equity internal rate of return. First as a levered and second as unlevered. So it is taking the amount of debt we have taken into account and removing that effect as well. Here we have our EBIT, depreciation added back, change in working capital capex. Then we have free cash flow to the firm. That is the cash flow that is available to the firm, and we have not deducted any financing activities from this. Then we have cumulative cash flow, and here we check in the at 40 year we will be able to generate positive cash flow. So in the year 11 we are able to generate a positive cash flow. That will be a payback period. So next we have a discount factor, which takes into account the discount rate that we have assumed in the initial assumptions. Then we have the present value of our cash flows, and this will be the financial matrix, the investment that we have done, the profits we have received, what are the proceeds from this. And we have a multiple of our multiple into the that shows us how much proceeds we are receiving compared to the investment that we have done. Then we have project internal rate of return, which shows us at what rate of return the net present value will be 0. Then your discount rate, net present value, and the payback period. We have done the same thing for equity IR levered. So this was the case if we have not taken any debt. Here the internal rate of return is 8.6%. If we do the same thing by taking the debt, we'll see that we have equity IR at 90%. So taking debt is the better case here. So equity drawdown is here. So how much equity has been drawn down? This is the cumulative one. This is the interest that should be funded. So this is the interest that has to be paid off with equity. And lastly, the cumulative repayment that is to be funded. These were all the free cash flow analysis. Then we have summary sheet that we have already discussed. Then we have some of the charts showing the revenue breakdown that we have from power purchase agreement, energy market price. Then we have the electricity produced bar chart showing how much electricity is being produced. Then we have a financial debt to EBIT ratio chart. And then we have our free cash flow. Well, if you can see around year 11, we are becoming cash flow positive. So this is also crucial for us. So with this, we have come to an end of this video. We hope you liked this video, and if you want to explore this financial model, a link will be there in the description for this model, so you can check it out. And until next time, thank you.